First of all, what do treasuries want, Stephen? I don't know whether there's a kind of like a market call on what they want to hear from the president, or whether there are other factors at play.
I think there are other factors at play. I mean, we've made a call in our long-term capital market assumptions book that treasury yields would normalise over the next 10 to 15 years. And you know, the reason for calling it normalisation is that as we retreat from unorthodox monetary policy and central bank intervention in the shape of quantitative easing, that took yields around the world to levels that were extremely low in historic terms, and levels that also bore no relation to nominal GDP growth. So if we think about the pace of growth in the American economy at the moment, you've got real GDP of, say, 2.5, probably 2.5, inflation 2, that gives you nominal GDP of 4.5, and treasury yields, 6 months ago were 2 or below 2. So, you know, we think that the bond market is just pricing the current rate of growth in the economy, and also pricing an exit from unorthodox monetary policy by the Fed.
But why now, Holger? If you look at treasuries, and there was quite a sharp movement over the last, I would say, 2 to 3 weeks ago, there's nothing actually fundamentally different. I mean, we had a little bit of data, but is it just the market playing catch-up?
It's probably the market's playing catch-up. Bond yields should have risen significantly more last year already on the pure economic data. We do have a synchronized global recovery, and the markets have come to believe over the first few weeks of this year that this recovery will indeed continue this year, and now the markets are pricing that in. We're probably heading for 4 rather than 3 Fed hikes this year, so the markets should adjust to that prospect.
So, Stephen, how many rate hikes are you expecting? And is the danger that actually inflation doesn't catch up, or isn't there as much as the Fed is expecting, or is the danger that actually it overshoots and we get to 2.5, 2.6% very quickly? So
on your first point first, I don't expect any more than is indicated in the dot plot. So, you know, I'm not going to stand up to our consensus on that one. And out of interest, I don't think the dot plots were actually fully discounted in the bond market as recently as 6 or 9 months ago. So a lot of this move is just catching up with the indications that have already been given by the central bank. Is inflation going to run away? Well, it hasn't so far, and the US has been close to full employment for months and months and months. You know, the jobs picture in the States has been extremely, it's certainly been better than many countries in the rest of the world for most of the last 5 or 6 years. US growth has held up during that period, and yet there's been no response in inflation. What we're starting to see for the first time coming back to the bond market is a sign of a move in inflation break-evens and in inflation swaps. But even they are not predicting, you know, a massive spike in inflation at the moment. So I think we just have to wait and see. The Fed themselves have called attention to the fact that wage inflation has lagged where they would have expected it to be, given the tightness of the labour market. So we'll just have to see if there's a wage response.